everyone, to this week's update, except we're going to take a break from our weekly updates and we're going to take a look at the U.S. economic outlook for 2020 and beyond. With all the craziness that's happened this year with the pandemic, we wanted to kind of take a look back at the first half of the year and take a moment to consider what the impact will be for the second half of the year and going into 2021. And our presenters, as usual, our founder from Inception Financial Services, Senior Investment Manager Edward Hsu, and President of the AFI Group and Financial Advisor, Entrepreneur Brian Walker. Welcome, gentlemen.
All right, thanks, Robert. I appreciate it. And, for the agenda, obviously, we're going to go through the first half of 2020, but the vast majority of us, well, we know what happened because we had to live through it. And if we had the news on for even just a few seconds, we're bombarded with everything that's going on, both in the world and in our financial markets. And we obviously know that the government had to step in to help take care of that. So what we want to do is we want to kind of take a real quick look, and we realize we came off a decade of unprecedented growth, one of the longest in history, which basically took a nosedive off of a platform dive into the pool and went straight down, without prejudice. So what happens is the government ends up having to step in to help us. And, we know that a lot of different things happened as far as the market goes. We know that the market tanked 35%. But what a lot of us don't realize is that the recovery was mainly led by large cap growth stocks, essentially that particular asset class. And you can see everything else were laggards. They lagged behind. And a lot of people don't realize that. In fact, Brian, this is just part of the story. We've got sectors that perform substantially better than others as well, right?
Yeah, I'm sure it's no surprise to anybody that tech did well. We're all stuck at home, told to stay at home and work from home and school from home. So you can see here, obviously, tech stock really kept the stocks going up, or kept the market going up. And what took the biggest hit? Energy, right? We're not traveling as much. Airlines are shut down. It was like the world came to a standstill. So it's no surprise what did well and what did not do well. So
yeah. If anything, one surprise there is kind of the consumer staples, right? A lot of the big box stores did pretty well over the course of the pandemic. They were necessary to stay open. Most of them were sold out of toilet paper for months on end, which we were rationing like a socialist nation, right?
Don't forget the Clorox wipes.
Yes. Clorox wipes and the hand sanitizer as well. And of course, no surprise, people look for safe havens in bonds, and, treasuries, long-term treasuries performed incredibly over that time, even with the mounting debt, that America keeps growing. It's still seen as one of the safest investments that we have along the way. Brian, I don't think this is much of a surprise that your high yield strategies, including real estate, suffered. We have a pending real estate crisis on us anyway, right?
You mean REITs didn't do well when no one had to pay their rent or their mortgage? This is people responding to the situation and all of the shutdown. And really, again, it's not a surprise to see these charts and see where people went. They went to very, very conservative, right? Not worrying about income, just worrying about keeping what they've saved.
Yep. So, exactly. And obviously the story is, realistically right now, we're still experiencing the benefits of that government stimulus, right? The shutdown, obviously we had, and the roller coaster is definitely the best term for it. We took a nosedive and then came storming back. But the real question is going to be, where can we go from here? And the next slide, I think, really shows it too, Brian, is kind of the path we were on for our debt and what happened as a result of this.
Yeah, it's pretty interesting to look at the last slide that you just showed along with this slide. And we see the stock market going up, right? Government stimulus, stock market going up, but our spending, government spending and deficit going down, right? Our deficit just, we become more and more in debt. And so by June, we were already spending about 3 trillion more than what we were projected to spend. So
yeah,
that, I mean, what's going to happen when that runs out?
yeah, and that's what's crazy is that's not actually all of truly the spending, because what you had is the Fed who steps in and essentially more than doubles or almost doubles their balance sheet to try to stabilize the bond market, to provide liquidity to capital markets, so it's at a point where they were finally winding down their balance sheet from the 2007, 8, and 9 recession. Now all of a sudden we get hit with this, and they have to step in to try to help correct things along the way. So, we all lived through it. Hopefully that was a quick little recap and wasn't too painful for most of us. So really what we want to take a look is, what does this latter half look like as well? And that's not LADDER, that's LATTER, the latter half.
Yeah, tell us, Eddie, please. Inquiring minds want to know. What should we expect?
True. That's true. And a lot of people don't know the term index concentration that's on this slide, but we're going to take a look at kind of labor markets, what that can impact. When we talk about earnings, I feel like we've entered a period of what I like to refer to as irrational exuberance, where the market is headed, and we'll talk about that a little bit. The Fed obviously lowered interest rates to 0%. We'll talk about that. And then what's on everybody's mind as well is November, that election. What can happen as a result of the election? And ideally, we don't want to panic as a result of that, but we want to ensure that our plan reflects our goals and our investment strategies along the way. So I'll go ahead and talk about the index concentration, and this is what can be a little bit misleading. I talked about it a little bit, I touched on it briefly at the beginning, but what most people don't realize is that only 8%, so roughly 40 of the companies that are listed in the S&P comprise half of that entire index. And why is that? Because the index is weighted based on the monetary size of the company, or the market capitalization is what it's referred to. So when you have these tech companies that are rising substantially, they're the ones that are really impacting and affecting how the S&P index has recovered and grown. So I talked about 8% representing 50%, but you have only these 5, right? What we refer to as almost like the FANG stocks, except you have Microsoft added in there as well, that comprise 25% of that entire index. So it isn't representative of a broader recovery that a lot of people may think is existing within the markets. Now, over the last month or two, a lot of those laggards have started to come back, but they have definitely not produced to the level that these 5 as well as those 8% of those companies have created.
Yeah, and let me talk
Brian,
a little.
you want to talk about the price and earnings and kind of the disconnect there?
Yeah, sure. So I know we've touched on this in the past on some of our weekly videos that we do. And, I think we can all agree that a stock price really is dependent on how the company does, the earnings of the company. And what we see is that these stock prices don't seem to care at all about the earnings of the companies, because the company's earnings right now are negative, yet the stock prices are going up. This makes zero sense at all. So, this is something that we warned about in the future in past recordings, and we can see here that a lot of these indicators that we look at are just not making sense. Okay,
Yeah,
so
I think talking about shrugging off the virus is kind of crazy, and it is. You take a look at PE, price earnings ratio, PB, price book ratio, price for cash flow, price for sales, and what we're doing is we're seeing, again, I'm going to say it again, this irrational exuberance of people just buying in and buying in and buying in, and in fact, I think it was it Bernanke, or no, actually I think it was Alan Greenspan, Brian, in the 90s coined this concept of irrational exuberance, basically saying that he felt that, and numbers can be fairly similar to this, where you remember the 90s, the market just kept going up and up and up. And do you know when he said that, Brian?
when did he say that?
He said that in 1996.
Oh
So
yeah.
already the market was looking overinflated. And what does that mean? That means, can this continue? Yeah, it can, because after he made that comment, the market's continued to rise for 4 years.
Yeah.
The question is, do we know? Do we know if this is going to last another month? Do we know, is it going to last another quarter? Do we know, is it going to last another year? Could it last another 4 years? Based on the data, I think 4 years would be a little bit excessive, but we don't know. But it still continues for right now. It is. It's pretty crazy.
Well, yeah. Let's look at unemployment, and how that relates. I mean, if we have these companies that are losing money, right, and yet their stocks are growing, again, makes zero sense. Look at the unemployment rate here. I mean, the official unemployment rate is basically saying we're at just under 12%, okay? But we have an unofficial unemployment rate that's nearing 20%. So we have people that are still collecting unemployment. And, this is just causing more and more pain and suffering and
Brian, I always feel like some of the numbers that are put out it's almost like they're meant to deceive, to paint a rosier picture, because the official unemployment rate is not based off of all those people that are the total number of people that are collecting benefits and the total number that are eligible to be in the workforce, right? And that's why we see, realistically, that unemployment rate is closer to 20% than closer to 12%. And that is staggering. And that is not something that is going to be corrected in the short term. That's going to take time.
Yep.
Especially with people talking about the new normal.
Yeah. And if these companies are losing money, how can they afford to hire more people?
Yep. Yeah, for sure. For sure. So let's go ahead and move on to the interest rates. And obviously we know that the Fed essentially dropped interest rates to roughly 0 to 1/4 or 1/2%. And I don't know, Brian, I don't really see that changing anytime soon.
We have just overall in our country right now, we have a very interesting time, and we talk about this on our retirement webinars that we do. We have the baby boomers, right? And what are the baby boomers doing? They're starting to retire, and when you're retiring, you don't want to lose money, right? So we have this crazy market, and so we see a lot of people moving into low yields like bonds and, things like that, that they just don't want to lose. And
Yeah.
so it's just a kind of a domino effect, what we see and what's happening. So, just given that alone, I can see these low interest rates remaining for quite a while.
Oh, for sure, for sure. And then that doesn't even consider, I mean, one of the biggest events coming up, obviously, is the election. And
don't get going on the election.
I know,
We're going to
I
create
know. And
polarization.
well, yeah, I mean, we see this, and the media obviously plays into it. The cultural divide, the polarization that's happening. There's a statistic here that shows, how people are voting and their voting convictions, and that's kind of proving that, a lot of people used to potentially just vote for who they thought might have been the best candidate, Brian, instead of sticking with party lines. And now it's more people are strictly voting down their party lines as opposed to, and honestly, I mean, it could be a situation where some people don't feel like you have the best choices available to you as well.
Yeah, this was news to me. I didn't really realize this. I try to say I just vote for who I think is the best candidate, whether they're
Yeah.
Republican, Democrat, Independent. But definitely, what you hear a lot these days is just voting for the party. So I don't
Yep.
know if that's really going to help us or not as a nation. I don't know if that's going to help us get through what we're seeing with the effects of the shutdown of COVID. But, I sure would like to get through this mess and get on to 2021 and see what we can expect, and hopefully see some better things going on, right?
Brian, I know that you mentioned in the last slide that you were excited to talk about what are we looking at for the first half of 2021, and I think we have one of the big unknowns is going to be what's going to continue to happen in the real estate market.
Well, Eddie, I'm not sure excited is the right word for, but, not knowing what's going to happen, but I am going to be excited to get out of this 2020. But what we've seen in the real estate market recently, it's kind of strange. For us that live in Southern California, we've seen real estate prices stay pretty strong, right? But we have a lot of people that are not being able to pay their rent. We have a lot of people that are not being able to pay their mortgage. And so how is that going to have an effect on real estate in the future? And are people going to be able to afford real estate? So, I know there's a lot of policies that, some of our politicians are trying to put into place to help protect those people that can't pay their rent or their mortgages. But also, what about the landlords? What is that going to look like for them? And to be honest with you, my personal opinion, this whole thing is a mess. So that's going to be real touchy subject in the future. And then we have our fiscal and monetary policy. So, I think the Fed's pretty much laid out the plan of what to expect for at least another year or two. I mean, we've taken those difficult steps. Interest rates are at historical lows. I think the Fed is indicating what to expect. But the big unknown is the fiscal policy. How are things going to change? What are things going to look like after the election? How are taxes going to be changed? I think that's a huge issue on, if the incumbent stays in, how are taxes going to change? They're probably going to stay pretty similar. And then if the challenger comes in, how are taxes going to change? and I've seen some reports where they look very different. So,
Oh, yeah.
you know,
Well, I mean, you have a lot of, initiatives that, the challenger wants to implement in order, I mean, we've heard, talk of the Green New Deal and a lot of those things, and those would be significant and substantial changes to fiscal policy in order to be able to make those a reality. So, I mean, there are a lot of question marks there, that's for sure. And Brian, the last thing I wanted to touch on is, again, the stock valuations. I talked about the exuberance, with stock prices rising off of these negative earnings reports in general. And that is a huge divergence that at some point is going to have to gradually start coming back together. I don't want to use the bubble word or that term, which we've used.
Well, you just did.
Yeah, but the thing is I don't want to, I don't want us to think that we're in that territory yet, but I would say for individuals who have money in cash, now's not the time that I would dump everything into the market. If we do want to get into the market, dollar cost averaging is definitely a great way to go. Just because, we saw in one of those earlier charts, Brian, that the prices, most of these stocks are pretty expensive. They're trading at what I like to call trading at premiums, right? So you're paying more, hoping that the earnings, continue to rise in the future. So, you want to do a little summary for us here, Brian?
Sure, why not? Let me get through this. Obviously, the pandemic has caused some major challenges on our stock market. And in some ways, the market is not responding how it normally does. So we need to be very aware of that. Government stimulus has definitely helped the economy to stay up. And also helped the market stay up. And so the second half of this year, we expect for our labor market continues to struggle. Unemployment will probably stay pretty close to where it is. Volatility in the stock market will probably increase again. I know that the Congress is trying to agree on another stimulus package. So, we'll see how that goes and see how that affects volatility in the market. We do think that the Fed has locked in some pretty low interest rates, and they should remain low for, probably another year or so, at least. And then, investors, don't change your financial plan based on the election, okay? Let's not get emotional over everything. Let's look at the facts. Let's look at the numbers. Continue to talk to your financial advisor and stick with the plan that you guys set forth. We know that the monetary and some of the fiscal policies have been set forth. It's going to take some time for some of those policies to change based on who is in the White House. So, if depending on who gets elected in November, we don't expect to see super fast and quick responses to that.
Yeah, a lot of those changes take years, and there can be emotional short-term responses from the market to some of those, some of those changes that are implemented, even though it does take years to realistically experience the effect. Yeah. But it's one of these things, Brian. I guess for me, the way I can summarize all of this is we know what to expect, which is a bit of an unknown. And so we want to ensure that our plan reflects our long-term goals and that we try not to get caught up in a lot of the short-term changes and impacts that can happen as a result of pandemic, as a result of election, and look and stick to that plan and look toward the long term.